Thank you, sir, for accepting our request and sharing your valuable time with us. Before moving on to the session, few set of instructions for the listener. Please keep your video off and audio mute so that we can avoid any kind of discrepancy that arises during the session. If you have any question during the session, I would like to request you to put it in the chat box below. After the session, we will have 10 minutes of question answer round, whereby we will take up each questions and we'll try to address it to Dr. Basu. A feedback form will be shared to you in the chat box. Kindly fill it up as it is necessary to share the e-certificate to you via the mail ID that you will provide in the feedback form below. Kindly allow us 1 or 2 weeks of time to share the e-certificates with you. Without further delay, I would like to call upon Professor Amitava Ghosh, Head of the Department of Commerce, the Heritage College, to introduce the speaker and begin the session. Over to you, sir.
Honorable Executive Director of Kalyan Bharati Trust, Mr. Praveen Roy, Chief Executive Officer of Heritage Group of Institutions, Mr. Pradeep Agarwal, Dr. Pushpita Ranjan Bhattacharya, Principal of the Heritage College, colleagues, friends, guests, my dear students, and the esteemed speaker. Welcome to today's webinar on a topic that is perhaps going to affect the recovery path of the global economy in general and Indian economy in particular. You know that the scale and speed of economic collapse that the world has witnessed over the last 3 months is unprecedented. The global economy was slowing down even before COVID-19. But contrary to real economic indicators, financial markets, particularly the stocks, was defying the reality. The pandemic broke the illusion as many developing markets crashed, resulting in massive outflow of portfolio investment and severe depreciation of local currencies. As a result, dollar cost of servicing debt is going up for the developing economies. Moreover, developed economies have already piled up a debt of 190% of their GDP. The developing countries are also expected to lose a large amount of export revenue at a time when their domestic economies are contracting. India is possibly heading for a depression, not recession, which may last for 2 to 3 years. Liquidity infusion into banks will become meaningless unless the money reaches the economy. Against this gloomy global scenario, we are very eager to hear from Dr. Basu the possible impact of the pandemic on Indian financial markets and the recovery path. Thank you for your participation in today's session. Now, without further delay, I turn the time over to Dr. Shankar Basu. Thank you, Dr. Basu, for accepting our invitation. Over to Dr. Basu.
So, thank you very much for inviting me to do this session. You know, we're still, some of you are actually far more proficient. We are still trying to figure out how to handle this technology and do it. We are far better off using the board behind me to do the session. But, you know, times are such that we cannot do that. COVID-19 financial markets and Indian financial market in a sense, in particular, is there an impact? And if the impact is there, what is it going to happen and how is it going to work out? What's going to how is it going to play out is the whole question. But before I do that, before we get there, let's start with looking at the world economy for a second. This is a pre-COVID environment world that we look at. This is basically the world economy. $80 trillion is the world economy in a single chart. The US contributes about 25%, understand, or was contributing about 25%. China at about 15%. And if you look at India, India is somewhere in the middle at about 3.2%, with a $2.6 trillion. Some people might argue that it is a little more, closer to $3 trillion, whatever, but it's about 3.25, 3.3% of the global economy. This was the pre-COVID environment. Upfront, what's going to happen post-COVID? Numbers will shrink as we've been seeing, as we've been expecting. Nothing new in that. Where will the 80 go down to is anybody's question, anybody's guess. However, there are certain benefits, certain green shoots, certain potential benefits which may dampen the effect, and I'll come to that in a minute. Will the percentages change much? Probably not. As a total economy may collapse a little bit, but will the percentages, will the US's 25% change much? It may change by 0.5%, 1% at best, but it's still going to be the dominant player. China, whether we like it or not, and given all the jingoism that's going on, whatever we believe or we say, it will still continue to kind of be the second largest economy at about 50% of the world economy. Nothing much is going to change. So this chart, even if I were to use this chart 2 years later, 1 year later, the percentages per se will not change much. Yes, the $80 trillion is expected to change. Why did I say at the same time, it may not change too much? For a very simple reason. I think the world per se has understood, across the board, there is no economy which is refusing to accept the fact that we are in a recession. And therefore, there has been a huge pressure across the board in terms of government, in terms of, government expenditure, government intervention by the US Fed, by the ECB, by the Central Bank of Japan, by Central Bank of China, and definitely the RBI in that context, and everybody else in the whole process. So there's been a huge amount of infrastructure money that's been pumped into the economy. Most of this is actually going to into the infrastructure framework. One of the other reasons why one believes that the economy will there will be problems, but there will essentially be some benefits coming out of this, is because, again, unfortunate as it is, for example, US in particular, if you look at it, is the largest economy, is also looking at a presidential election in less than 4 months' time, or maybe just over 4 months' time. Which basically means, and if somebody were to ask in the month of January of this year, or even February of this year, what are the chances of President Trump's re-election, given the way the economy had performed till then, given what he had delivered, I think it was a no-show. It was a walkover. Everybody was kind of writing it off by saying, he will win hands down, there's no point, whoever stands on the other side. The last 3 months or 4 months of COVID effect in the US has suddenly cleared that pitch. Will Trump lose? Anybody's guess. The current numbers show that he is trailing by about 10 to 14 percentage points to Joe Biden, who is the presumptive Democratic nominee. Will that translate to votes for him to be voted out? Probably, that's anybody's guess. But the reality is, suddenly the economic impact is hitting hard, which is why this huge economic benefit that Trump was proposing, or Trump kind of represented, is suddenly no longer there. So one of his targets to kind of revive his electoral prospect will also therefore definitely be in terms of pumping money into the economy, pushing the economy up, so that at least, on the economic front, he would have seemed to have delivered something. Will that be good enough? We don't know. And I'm not trying to get in there, and that's not what I'm trying to talk about. But all I'm arguing in that framework is that this will essentially ensure that there is money being spent, and money being spent at a point when the economy needs the money to be spent. We're spending the money in India, and I'll talk about that a little later. are we doing it the right way, and what impact does it have on the market is an important question that we need to kind of address. Let's look at, before we get further, let me look at, sorry, there's a typo. I can see it should have been domestic, and I know what I've typed out there. But anyway, what we see in the current economic environment is probably the lowest growth in the last 40 years. We all know what various rating agencies have also been telling us. We are from negative growth rates to just about 2%, at best 3% growth is what in the best of scenarios. The last time the world, particularly in India in particular, saw negative growth rates was in 1978, 1979, in the Janata Party, Marathi Desai Janata Party government. But please remember that was also the time when that government took very weird economic decisions. And one of the most weird economic decisions they'd taken at that point was throwing out multinationals. So basically, they translated the whole equation by saying no multinational can own more than 40% in Indian companies. This was an overnight decision which led to a lot of multinationals withdrawing. IBM, Coke, a lot of other companies withdrew without the substitute effect being in place in India, and hence it took a fair amount of time to kind of recover. So that was the last time we actually saw a contraction in the economy to the extent of negative growth rate. Growth rates have varied after that, but we've always been in a positive growth rate since then. And for the first time in about over 40 years, we definitely are not among the lowest growth rates, but we're also potentially on the verge of looking at a negative growth rate. I hope not, but that's a possibility. It's also led to a very high, one of the problems that has also led to is very high levels of unemployment. Because one of the problems that's happened, which is the solution that has been talked about, and this has an impact in the financial market also, indirectly. Because from the government's perspective, from the regulator's perspective, the model has been, well, there's been a lot of money that's been pumped in. Again, one can keep on debating politically whether the 20,000 or 20 lakh crores that has been earmarked, promised, or whatever, is it all cash? Is it in different forms? Let's not get there. But the fact of the matter is that 20 lakh crores is a fairly large amount of money for the economy. Now, where does the government have the money to put it is one important question. But because it's about 10%, they would write approximately about 10% of the GDP, it's approximately more, it's just a shade lesser than the total tax collection or total revenue generation in the country in the last year. So if my entire revenue has to be put in there, I have hardly any savings left. So how do I run the rest of the government? I don't know. But the question is, if that money is put in, there is a huge impetus that has been put into the thing, and therefore the expectations of markets should react. The markets unfortunately haven't. And the problem why the markets haven't reacted is very simple. We have created, or we have tried to address a supply side problem. We have completely neglected the demand side of the problem. So as I was saying, so we've created demand.
He has made it very clear.
We've kind of addressed the problem on the supply side, not on the demand side. And hence, the markets are not picking up because the demand, the income is not really happening. I'm producing more, I'm creating inventory, which is not good for the industry, but I'm really not having money on the ground or money in hand to be able to spend, and hence there is a problem that is getting created, which obviously is turning into the unemployment issue. In the height of the COVID, the government and then the whole system rightly so argued that nobody can be sacked, jobs have to be protected and all of that. But at the end of the day, if we believe and if we live in a free market environment, if the employer does not have, or if the industry does not generate money, does not generate enough capital, where will the employer service the employee from? And if that doesn't happen, there will be, mass scale layoffs, which we are just starting to see, and that will create, even more unemployment. We were at, as it is, fairly high unemployment. I need to add one more line out here in terms of the Indian economy in particular. COVID has had a very negative effect, no doubt about it. But let's also realize that COVID is not the only problem. We were in an economic mess prior to COVID. Because if you look at, even if I just look at the Q4 data for last year, the 1920 Q4 data that just came out about maybe 2-3 weeks back, growth had dropped to less than just about 4%. The question is, COVID in India impacted the last 7 days of March. how could the growth in India, the growth in that quarter, drop so much for a 7-day factor? So while COVID has and will play a long-term impact, but to say that we were all fine and COVID has come in and therefore we are in a mess is not really a right thing to say, because we were in an economic slump, we had an economic crisis going. COVID has acted as a super catalyst, in my opinion, and has aggravated the whole problem. The recovery plans that we thought we had and things like that have all been now thrown out of the window, because it's not just a pure economic thing, it's the rest of it that's also coming. Labor migration has an impact, and it will have a larger impact, because a lot of the industries which were labor dependent, but the labor supplier states and the labor consuming states were different. Suddenly the labor has moved away. It's not that easy to get people back immediately and restart operations. So even if there is a demand, I'm not really going to get people back in there immediately to restart. And it's not also equally easy to say, okay, let's shift production from state A to state B, because there's a whole gestation period that's taken. So migration of labor, which has happened and which we've all seen, will really have an impact on the economic environment. Couple of other things, which is obviously the case. One of the things that COVID-19 has shown us is the real lack of public healthcare system in India. And one of the problems that we have is a real lack of proper public healthcare system. And and on one count, this is going to spur us into spending more on the healthcare sector. But at the end of the day, we don't have, the amount of capital, amount of resources we have is limited. And hence, it will be at the cost of some other sectors. So which are the sectors which will get impacted is going to be the question, but that will have an impact because these sectors are no longer independent of each other. And finally, the global recession also creates a problem, though not much. I always would argue global recession will have an impact, but the impact of global recession on us is going to be much lesser than the impact of global recession in some other countries. The simple logic for me of using that is, if I look at RBI data, our external sector contributes to about 10 to 15% of our GDP. And even if I add a little more to that, maybe 25% of our GDP, which means 75% of our GDP is still domestic. And if we can get the domestic side right, yes, I'll still have a dampener in terms of the 25%, but I'm not dependent. I can still run with 75%. It's like saying I can still run, I still have enough material, enough fuel to run for the next few months, maybe a year or two, by which time the global market should come up. But to say that the global markets will have no impact is also not correct. Global markets will have an impact, but it's not going to be as detrimental as things will. I'm going to skip this slide. This slide is just that good. But if you look at it, it's actually across the board. And Professor Ghosh was talking earlier about banks. It's not just banks which, these are the players, and it's not just banks that are going to get affected. If you look at it, all of them kind of get affected. Each and every one of them kind of get affected. Because they are so interlinked with each other, the market does not really operate. The market does not, there is no real market to operate. If the banks, and I have a slide in the next couple of slides there, the banks will land up into a problem, and therefore everybody else in the whole system kind of gets impacted. So the argument is not just the banks, but all the players in the financial market will have an impact. Why do I have this? There's a reason why I have this, not just because I want to show, and I know every one of you out there will be able to tell me much more than just these 4 bullet points on the slide in terms of regulators. The reason I have this is to argue the fact that unfortunately in India, there is no regulatory congruence. Even today, RBI, SEBI, IRD, everybody is fighting with each other in terms of turf war. But the market on the other end is fairly integrated. So unless we have an integrated response in this whole story, PFRD is a small player, you can leave that out. But the others, unless you have an integrated response from a regulatory side, we are really not going to get anywhere positive. We need to have an integrated response, and that is where the regulators need to come on board. It's actually very unique that we have, because as all of us know, our legal system, which is not even with the national market, but our legal system is predominantly based on the UK legal system, given the history of the British colonization and all that. Yet the financial regulation model, or the financial regulatory structure, is based on the American regulatory structure, where each one of these regulators are independent of each other and directly report into the Treasury or the Ministry of Finance. Under the UK model, if we had the UK model, we would then have a super regulator on top of this, which in the UK is called the FS, the Financial Services Authority, and that is a single point regulator under which everybody else functions. So, and that, at times in markets like India, is probably not a bad idea, because then you have an integrated outcome, an integrated policy response, as opposed to RBI doing something. SEBI has something completely different going on. IRT has some other rules going on, and therefore there are kind of fights, there are kind of these breaks, the gaps that get created. Sometimes the gaps are avoidable. I mean, in all cases, the gaps are potentially avoidable, but in some cases, people get away easily by just a market reaction. But what, in a bigger problem could happen is the gaps could be utilized by market players. Some would make money, but obviously it's a gap in the system. And therefore, and at some point, the thing will fall through the crack, and the effect in the market will be hugely negative. That's a worry that remains in this process when our responses are not integrated in that fashion. Okay. One of the important things, and I think this is one of the most important things that would drive economic revival, financial markets in India, is the financial literacy. Unfortunately, for all that we've said over the 70 years now, or over just over 70 years, we are nowhere close to be financial literate in a country like ours. But that's not to say us, even the US is not. US learned it the very hard way in 2007-8 crisis, post which a number of states in the United States made it mandatory for their class 12 students to pass. I think 16 or 17 of the 51 states have made it mandatory, where they need to have a certain understanding of basic financial literature, financial jargon, to be able to even graduate from school. Unfortunately, we don't have it, and therefore, every one of us believe we know of it, and that financial illiteracy has really a huge problem. There's a huge divide between urban and rural India. Majority of the responses will have to come in from rural India, and there is financial literacy problems. Financial access is also a problem. And hence, I think if you combine these two have a definite impact, because it lies into the demand. I mean, all said and done, and this has been going viral on WhatsApp and Facebook and everything since yesterday. While we, the middle class, seem to sit in drawing rooms and solve everybody's problems, the real problems have to be solved on the ground by somebody else. And they are exposed to these problems. And if we do not address these problems, there is an impact. And at this point in time, this will lead to a much larger impact that we can think than we've ever seen before. Now, what are some of the major issues that we're going to have? Well, obviously a recession. Sorry, it should be economic, not economics, economic recession. We are already in a recession. The question is how deep and how long. We don't know. Nobody knows. Even the best of economists won't be able to tell you how deep and how long. It's as good as astrology, it's as good as predictions of a model. But the fact is, there is an economic recession, and the tried and tested method of getting out of economic recession has been government spending, government bail. I mean, in short, government bailout. The problem is, does the government have the money to bail us out? Does the government have the ability to bail the system out? And for how long can the government bail the system out? That's going to be a huge problem. The other issue, which will have a significant effect on the markets overall, is a lower consumption, leading to a lower demand. Now, one of the reasons why India has generally been insulated from global crisis at some level is because the high level of savings that we've had. Our average savings rates have been anywhere between 27% to 32% of our GDP over the years. But if you look at it over the last 5 or 6 years, the savings rate has started going down, and it is still not reached the 3% or the 2% the developed economies have, but it has definitely gone down from the peaks of 31, 32% that we had. I think right now it's up somewhere about 21 or 22%. Now, that's not bad, but the trend is that we've been saving less, and that could actually create a problem. That could really have a problem, because we may not have the ability to spend. That would therefore lead to a lower consumption, which will lead to a lower demand. Now, areas of consumption won't change, agriculture, food, and things like that. But there are lots of areas where consumption is going to change, which drive the economy, and it's a chain effect. So, for example, one of the segments where I guess the consumption demand will be hit immediately is the real estate industry. Now, not buying a house at the top level, somebody not buying an apartment or a house is a microscopic recession in the scheme of the entire economy. But look at it. If that kind of if that kind of blows out of proportion, there's not just the buyer and the seller, but there's a whole set of people down the line who's linked up to that entire industry. And the cascading effect can go and hit many more people. That's just one example, and this can happen in various other things, various other segments that one would kind of land up seeing. Discretionary spends, when a part of this is discretionary spends are going to kind of come down, definitely, for certain. People would want to be sure and certain than take a risk. So the risk-taking appetite, the risk appetite, the ability, even the possibility of having some, making some, I won't even say risky, but not so sure decisions is kind of go down, and therefore discretionary spends are going to be something which will be significantly out of the equation. Where does directly the markets get hit or where the financial system get hit? Larger NPAs, potential defaults. And I'm not necessarily saying NPAs and defaults from a perspective of deliberate default or deliberate non-payment. We could actually land up in a scenario of inability to pay. Till now, most of our defaults, most of the NPAs that we have seen, unfortunately in India has been not an inability to pay, but a willingness or the unwillingness to pay. I have the money, but I don't want to pay, or I want to do other things with the money. And, the system kind of is lax enough for me to go through that. But I think we are now going to get into the position where the inability to pay will become the real driver, leading to larger defaults, leading to larger NPAs for the banks. The banks may land up with assets, non-paying assets. Even if they're paying assets, what do they do? Because the bank is not in the business of running an industry. And the bank cannot go and sell it in the market because if they sell it in the market, the cost at which they sell is actually very low, and therefore we can actually end up seeing non-payment non-performing assets and defaults significantly increasing. How do we address that? I have a slide in the next one where I kind of briefly mentioned about IBC, but I'll talk about that. Changes have been made to the IBC code to allow for not declaration of defaults and all that. But will it be good enough? Particularly if there's a large entity, and how much of it will carry forward by delaying the declaration of a default under the changed IBC now? Will that be essentially prolonging the crisis? Is something which one should wait and see. But really, that could actually create a bigger mess in the whole thing, because it's like saying I could have stopped the problem today, but by not stopping the problem, I've actually wasted good money over bad for a longer period, and I've ended up with a bigger problem at the end of it. Uncertainty is going to be the key word, at least for the next year, maybe a year and a half, and that kind of will translate to, in the simple argument, as volatility being very high. What does that mean? What it means is both good and bad. From a financial market perspective, it's both good and bad. Because there are some people who would be ready to play on the volatility, ready to take the risk and say, okay, I'm ready to risk it, because if it translates, I make significant benefits. But a fairly large majority will actually play safe and not really get in there or want to exit. And that could actually create negative effects in the system, and that could actually have a problem in the whole thing. In this, in a sense, if one were to add one line on top of that, if somebody has the staying power, if somebody can kind of say that, okay, I have some spare resources available for the next year and a half, I think, and at some level, this is a fantastic time to try to enter the market, but as long as you don't expect a very short-term return on that. But over a longer term, but the only problem in this over a longer term story or argument is nobody really knows how long is this long term, and therefore at what point will the long term start generating the return is the question. One of the things that a lot of few people might be interested in, and I have actually put it out there, is suddenly the need for risk management will blow out of proportion, and everybody across the board. Up to now, I think risk management was only talked about in the context of banks or financial institutions, but I think increasingly we are now going to get into a world where the entire industry per se will need to have an effective risk management practice in place, including, for example, including educational institutions. At IIM Bangalore today, we actually have one of the senior most faculty on the board designated as the chief risk officer of the institute. 2 years back, this was unthinkable. What can be the risk to an educational institution? What can be the risk to an IIM Bangalore? But today we have a dedicated risk officer whose job is to kind of map the thing, understand what the risks, what the environment is, and look at the risks and try to mitigate the risks. We can't solve all the risks. We may not even be able to mitigate the risks, but we at least should be aware of the risks that are there. And that is something which is going to happen. And I just use this as an example simply because this is as far removed from the markets as one can think of. In the markets, obviously, this is going to be far more important to kind of look at better risk management techniques and practices. Now, some of these things have impact. We all know of this, so I'm not going to talk about this. But what has happened in the context of all of this is, we know of demonetization, we know of IBC and the subsequent changes, we know of GST, but all of this impacts the markets even today. The fact that GST happened approximately 4 years or 3.5 years back, there's still a thing, and today we actually have more cash in circulation and we don't know what's happening in the whole system. The IBC has helped somewhat, but has also got its own problems, and with the recent amendments to the IBC that has happened, this could actually be, it could be good for some, but it could also be bad, and that's where my real fear comes from, which is the problem that, I'm not cutting it off on day zero, I'm letting it prolong fester with the hope that I will recover, but at some point when it comes after 12 months or after 6 months, when I finally take the decision, I could have cut loss at an earlier point with a much lesser loss, but I actually have ended up creating a much larger loss in the whole process. Now that's a call that one has to take. At what point do you exit? There is no right or wrong answer in that. I don't think there is a right or wrong answer that I can give you in that context. But at what point do you exit will play a very important part in terms of how the markets kind of react, or what will be the impact on the markets. Why do I have GST? The reason I have GST is because, again, one can dispute numbers. One of the problems has been that the GST has kind of ensured the states really don't have the resources. Most of the resources under that is still stuck with the central government, and the central government has to pass it down. This also affects development and effort infrastructure and spending at the ground level. Because most of the spendings at the ground level will have to be done by the states, not by the central government. Some activities like highways and all is central government, but a majority of it has to come from the states. And if the states don't have access to the revenues that they should have, then there's a real challenge that will happen. And then that has an impact in terms of how the markets kind of react, how the markets will move from here. Couple of things. In the post-COVID world, what's going to happen? One of the things that we actually going to see, and this is arising from the implied unemployment and all that will happen, is something like this. There will be reduced human interaction. As it is, we are seeing this whole argument of social distancing and things like that is resulting in a reduced human interaction, at least a reduced physical human interaction. And there will be more reliance on self-certification, self-validation, automated processes in some sense. The number of transactions, on the other hand, will significantly increase. And it's already, because if you need to spend the 20 lakh crores or whatever amount that we're talking about in any part of the world, and every country has put in a lot of money, from about close to $1 trillion, just less than $1 trillion in the ECB zone to others, there will be a huge number of transactions that will happen. And we therefore need to kind of move into a world where we need to an automated system to be able to manage these transactions, which will kind of be needed to run this, to kind of hopefully revive the system. What we also need to, in the whole process, end up being able to do, and I believe, and I sincerely hope that this is what it's going to get to, is that the markets will react positively if we can make sure that we have the ability, or we have created the ability to deliver efficient and accurate services with high levels of accountability. One of the reasons the markets will not react or will react negatively even to seemingly positive developments is if the market believes that there is an inefficiency in the system, accountability doesn't exist, so it's essentially, you made an effort, you made all your effort, but it's not necessarily, translated into an outcome. I know there are a lot of students out there, but being a faculty on the other side, I'll give you a simple example. In this entire change that we are trying to get into in this online or this online-based, distance-based teaching model, a lot of faculty, a lot of us have had to really reinvent the way we teach or we will teach, because historically we were not used to teaching like this. We were used to coming into a class, using the board and writing, and I'm teaching in that. So I think a lot of effort is going in that fashion. My biggest challenge, and actually I haven't yet taught online, I'll start in about 2 weeks time, or 3 weeks time, sorry. But my biggest challenge is, I don't know the class on the other side. Because of a variety of issues, I can't see the class on the other side. So I do not know how effective I am being on the other side, and what are the students doing on the other side. And that's the challenge. So what will be the level of accountability in this whole process is the question. It's not that efforts are not being put in. Efforts are being put in, and fair amount of efforts are being put in by the faculty, by the students. But I think the medium that we still have, because of other technical and technological issues, we really don't know how do we manage the system. How do we kind of make sure that the delivery is actually happening in the way it should happen, and it's actually benefiting the people who should benefit. Yes, there'll be a lecture and all of that, but that kind of thing will kind of happen. However, having said that, the markets in a post-COVID world will have to enhance, will have to use technology as a means of survival. There is really no other alternative, and one has to leverage on technology to kind of enhance the profits, to actually have a better, to kind of make sure that they not only survive but thrive in some sense. Obviously, there are whole advantages of technology, and this is not the idea to talk about out here. And there are disadvantages. I will not get into any of this, but I will just wind down the whole thing by saying that technology will play an important part in the revival of the economy post the COVID, as we get into this unlock 1.0, unlock 2.0, and as we move forward. However, we should not, just because it's a technological solution, we should not treat anything as a black box, and we should kind of look at a hybrid thing. We should actually have parallel backups so that human intervention, direct human effect may be reduced, but cannot be wound down completely. It is not an automated world. It's not. We cannot run an AI-driven world entirely for a variety of reasons. One of the reasons being obviously the effect on employment numbers that will have, and obviously the economy that will have. So we will actually have to have some kind of a hybrid, some kind of a modified, a mixture model in place in all of this. Having said all of this, and before I really finish the last slide, before I get into the thank you slide, I think in short, I would argue that effect on the financial system is huge. Effect on the financial markets has been huge. Having said that, I think the financial systems across the world, India included, and I think India included right on top, were one of the best prepared systems across all systems that we see in the world to handle the pandemic that we have all been witness to, or we are all a part of today. If you actually think of it, every single regulator, though I've criticized the regulators at some level not being integrated, but if you look at it, every single regulator in their own way actually had disaster management plans which were effectively implemented, run, and continues today to run successfully across the board without hampering any financial transaction whatsoever. So to that extent, the one thing that I think one should always give credit to is the financial, and this is something which is very rarely actually tested, because the financial system does not really come into is not expected to get into a standstill or a closure at any point in time. Yet disaster management plans, backup plans and all are kept in place, and all of them have been activated to ensure, and there's a smooth, seamless transfer that has happened, which has ensured the financial system has not collapsed in any part of the world, including in India, where I think from a system perspective, we have delivered very well. What has happened is the outlook and the expectation of people of the economy of it going forward. That has been the challenge, and that is where the differences have come up, and that is where the markets have not done well. They're expected the recession has started, or recession has been there, and therefore, recovery, people's investments, people's income can get affected. And will get affected, no doubt about that. Nobody's denying that. But as a system, I think the system has delivered well. But having said that, just because the system has delivered today, will the system continue to deliver? Well, the system will continue to deliver as long as the regulators, the people in charge, the policymakers are always trying to, second guess the next problem and work, assuming the worst case scenario will happen, whereas in reality, the problem will actually be much lesser. So that is something which is a very important, positive that has come out of the crisis. That the systems, thankfully, the systems are robust. We manage the systems very well across the board, and to the extent there's absolutely no problem per se. Having said that, as I said, there's still a negative sentiment. Sentiments are negative. We are in for a long haul. We are in for tough times for sure. The way the efforts have been made, while the efforts are definitely laudable, but the efforts that have been the delivery mechanisms that have been used are not necessarily, at least are not showing up any results, and that could prolong the crisis for a longer period of time. At some point, it will come back because inherent demand will get created and you will come back. But the idea of all of this is to stimulate demand so that people start having money in hand, start spending more, and therefore the economy revives much faster. If I don't do anything, it's the same story as the pandemic itself. If there is no race for the vaccine, if there is no race for cure, will the entire population, will the 7+ billion people of the world get wiped out? No, definitely not. Maybe a few million, maybe 500 million people will get wiped out. Very sad. But at some point, herd immunity will come into force, and therefore there will always be a remnant, a resultant outcome which will redevelop and regrow. The question is, do we want to get into a scenario where we lose 500 million or 1 billion people from the world before we start to kind of regroup? And that, obviously not. And that's a negative argument. And that's why the race for vaccine and all of this, the cure and all of that is happening, which is why the entire medical world, the entire biological world, the biological sciences world is kind of really fighting against trying to figure out a solution. The same problem with our economy. If we don't do anything, at some point the economy will revive. You and I are kind of insignificant players in all of this. That is a given certain. But the question is, how long? That will be a much, much longer, a much, much more painful process. Is there a way to reduce the pain? Is there a way to reduce the timeline? And if there is a way, should we do it? Obviously, the answer is yes, we should, and that is where the effort should be. Otherwise, we will recover. I mean, whatever I say I do, the system will recover. But the cost is the question, and that's where the argument will kind of stand. We hope that some of these things will come into play. In the short term, we will actually have pain, but the pain is reduced to a short term, and the economy starts reviving because demand starts picking up, and that will really create the benefit that we will have going forward. Thank you.
I'm sure everyone present here has a lot to take away from that speech.
Sure.
Without further delay, I will like to open the question answer session. Participants are requested to switch on their audio. Participants who will be asking questions are requested to switch on their video and audio and first introduce yourself and then ask the question. The first participant will be Aparajita Mukherjee. Ma'am, please introduce yourself and then address the question to the sir. Over to you, ma'am.
First, I would like to convey my regards to Sir. Thank you for your valuable speech. Sir, I'm a guest teacher of Environmental Studies in THK Jain College. I would like to greet everyone, those who have joined. Sir, I have a question regarding the current situation that a lot of students, they were hopeful that after their graduations or their masters is done, they are going to join some job. So my own brother is also there, who is a student who is about to be graduate this year. Sir, I wanted to know that what is the scenario, how the future of these students will be. This is my question, sir.
Well, it's going to be tough. I think what's going to happen in the short term, we're going to see some job losses. We can also potentially see a problem of offers being retracted. But I think these are going to be short-term issues. Because fundamentally, for the economy to move forward, we need these people. What can happen and what is, in my opinion, a solution will come up is the kind of compensation that has been promised or that was expected might have to be relooked. Because, in a pre-COVID world, in a different environment, there was a certain amount of compensation that was being talked about. In this environment, that might have to be relooked. So I think there will be a readjustment that will happen. I think across the world, I think everybody will agree, for a qualified individual who's ready to work and ready to work hard, I don't think COVID or anything else will be a challenge. It is a difficult time to get in, but as people have been saying, as there was this famous video, obviously at the lowest level, this famous video by, I think it was by Sundar Pichai, he was kind of research, and he was giving a graduation speech at one of the US colleges, where he kind of highlights how people have survived, graduates have survived the 2007 crisis, the 2001 crisis, the oil shock, and gone back 100 years to the Spanish flu, plague, and all of that. And said, every generation has gone through that. It will develop. You are starting at a lower base, you will move up. It is, everybody faces the same problems at different points in time in life. And at some level, I think it's better to face the problem early enough than
of course.
Because if some of us lose a job, we will not. The real challenge, I think, is for the mid-level executives, because they will not necessarily be so easy for them to get another job. Whereas the lower level, because of the salary expectations can be adjusted, I think that should. On the whole, I think it will kind of, if you give it some time, maybe a year or so, I think things will kind of look much better. Because at the end of the day, we need these people, we need these qualified resources to be able to run the system.
Yes, sir. We are all hopeful. Thank you so much, sir.
Thank you so much, ma'am, for asking the question, and thank you, sir, for replying it so beautifully. Our next participant will be Shomodev Mondal. A request to the next participant: after you ask your questions, then kindly switch off your video and mute your audio. Over to you, sir.
I'm from Ramsada College, Amta. My question was that
go ahead.
If we can overcome the situation by adopting what have government offered, the 20 lakh crore, by investing in small and light industries. So if that can really help the employment of our India in future, if that can increase our employment.
Well, let's put it this way. You see, the 20 lakh crore, you need investments across the board. If you cannot just have MSME investments only, you need the large, because after all, a lot of the MSME products are consumed by the large industries. So you need the large industries. So you need the whole industry cluster to kind of develop. Will this help in our employment scenario? It should. But again, I will put it this way, whether 20 lakh crores or otherwise does not really matter. As long as demand for a product picks up, there will be somebody ready to produce that. And the moment the production happens, people will be needed to produce it. So employment will automatically pick up. So in all of this, instead of just producing randomly, we also need to make sure that demand picks up. Because if demand doesn't pick up, you cannot go on producing infinitely, because there is a huge inventory cost that you run. You produce, think of it, you invite 5 people home for dinner or lunch, right? You cook for 50 people. What's the whole point? Because the rest of the food is wasted. And even if you say, there is money, there is other resources that you spend on it. So, but if you have a demand for 50, you can easily, then the requirement to produce for 50 will be there. So it's not just production side, you also need to ensure that there is demand on the other side. Only then will, short term it might give me 1 or 2 more employees, but for a sustainable model, I need the demand side also to kind of grow for the system to work.
For a country like 130 crore people, can't we generate that much of demand?
I think for 130 crore people is our biggest strength. And remember, up to 130 crore people, about half of it, approximately, one can quibble on numbers, but approximately half of it, about 60-65 crores, is what is kind of the youth and the young generation who are generally given to spending more and really, I think consumption demand to be higher. So I think that is the strength that we inherently have, and we should capitalize on that strength and not really go back and say, oh, we have 130 crore people to take care of. I think 130 crore people is really a benefit for us.
Okay. Thanks, sir.
Thank you. Who's next?
Our next participant is Arinda, managing student of Heritage College only. Over to you, Arinda.
So in this current situation and after this post-COVID situation, people will basically feel a lot of issues in repaying the loans they have taken and also the interest on loans. So the main pressure will be on the NBFC sector and on the banking sector. So I would like to know how they can face this problem and they can come out of this issue.
See, you're right. You're absolutely right. That this will create a problem in the lending space, in both commercial and retail lending space that has already happened, where repayment will become a challenge or is becoming a challenge. And at some level, while part of it is obviously force majeure, you can't do anything about it, it's unforeseen. But I think also the risk management practices, the lending processes that these entities have used to lend will also come into question. What can we do about this? Well, we need to it's not a solution to renege on the loans. It's not a solution to, it might be a short-term local solution, but it's not a global solution to just declare as an NPA and things like that. I think, one needs to work through this, renegotiate the whole process. If you can't pay, if I was supposed to pay in the next 6 months, well, maybe take a longer period, but that also means I have to pay more. So I think there has been understanding on both sides that there has been renegotiation, both in terms of the tenor as well as in terms of the cost, to take care of this problem. Just by taking a hardline stand on either side is not going to solve the problem. If anything, it's just going to aggravate the problem. Because once you have a few failures, you will actually find that both sides are actually worse off. The best scenario, in my opinion, is to in each of the scenarios, to come and negotiate with an open mind, negotiate the entire terms, both in terms of the cost and in terms of the tenor over a period of time, which then becomes acceptable.
Our next participant is Arijit Bhattacharya. Arijit, please ask your question to sir.
I'm Arijit Bhattacharya, a student of the Heritage College itself. My question is that, sir, world GDP stands at around $80 trillion, whereas the world debt stands at around $270 trillion, is almost greater than 3 times the world GDP. So, sir, US has always been taking a policy of printing more and more notes in order to come out of any crisis. Whereas the agencies has continuously been supporting the US Treasury bonds and creating a bubble, creating a bubble-like atmosphere, which is resulting in the dollar being strong as it is, whereas the other currencies depreciating continuously. So my question is, do you feel in the long term, US dollar is going to lose this reserve currency status, the current and other means of exchange like the bitcoins and the gold is going to gain importance? Thank you so much, sir.
I completely agree with your analysis of the first part, and I seriously hope that happens. That some other alternate thing comes in. Whether it's I'm not so sure about Bitcoin, but some other alternate comes in. But do I see that happening? Very unlikely, because it's not that it has never been tried. Gold standard was disbanded in 1973. Subsequently, in the late 90s, 98, 99, the euro was tried. The euro was supposed to, at that point, build as an alternative to the dollar. Didn't really take off. Your IMF's SDRs have been tried. They have not really taken off. So, in a sense, I think I completely can't agree more with what you said about the US economy and the way the US has printed its way out of trouble every time. But I think also the fact that it's the largest economy, unless unless those ratios significantly change, I really don't see any major change in the dollar or the importance of the dollar in the market happening. Yes, if the scale of the US's contribution to the world economy changes significantly, one would expect to see a see change. But till then, I honestly don't see much of a change. I don't expect much of a change.
Thank you so much, sir. Thank you.
Our next participant is Subhangi Chatterjee. Over to you, Subhangi.
I am Subhangi Chatterjee. I am studying BCom Honours second year from the Heritage College. So we have seen a severe coincidence of COVID-19 and rate cut by RBI in recent months. It causes much lesser incremental income to a major part of the population of our country. So I want to know that how long this situation is going to persist and whether in near term investment of financial instrument can generate inflation adjusted bank FD return.
I wish I knew the answer, and I wish if I knew the answer, the government would appoint me as the RBI governor. Both are not going to happen. But I think the fact is, you're right, that interest rate cuts by itself don't work. I mean, it is what, I mean, and I saw this, as I was speaking, I saw this comment coming, including from, I did see Amanat out there also making the comment that interest rate cuts and all of that. But the argument remains that interest rate cuts are good as long as it's a complete package by itself. Why is interest rate cut? Because fundamentally the argument is therefore there will be more consumption demand, people will not save, people will move savings into spending, and therefore there will be a demand that will get created. And the whole system will kind of move forward. As long as that happens, it works for a short period, which is why the interest rate cycles happen. The interest rate cut will at some point be reversed, and you will start moving back up, and interest rates will start going up. And when I say high, I'm comparing it with the rest of the world. In a high inflation country like India, where even if the inflation is at 6%, the US inflation is about less than 1%. So I think, for a high inflation country or moderate to high inflation countries, and social security, and the biggest argument is that social security is pretty much non-existent. So though constitutionally we are a socialist republic, the democratic secular socialist republic, in reality we are not a socialist republic. Social security does not exist for majority for anybody in India. In that scenario, yes, it could actually have, if it is carried on for a very long time, it could actually end up having a negative effect in that whole process. And that can come in, which is why I've been arguing and I've been harping on this thing, that all of this is fine. You can do rate cuts in the short term, stimulate demand, but demand needs to be stimulated. Supply will automatically fall in place if demand is stimulated. Until that time, the problem will be there, and we need to address it from that side.
Our last question for today's session, I would now request Dr. Amit Majumdar to come and ask his questions. Over to you, sir.
This is Dr. Amit Majumdar, Assistant Professor of Commerce, Vijay Krishna Lal College, Howrah, University of Kolkata. It is always a nice experience to listen again by Professor Shankarshan Bosu. Like the other days, excellent deliberation. And I'm really grateful to Heritage to give me the opportunity to listen from you again. So just in your lecture, you have mentioned about the risk management professionship in the esteemed institution like your IMB. But sir, do you think this pandemic throws the biggest challenge on our conventional education system? And if we just consider the views of eminent scientist CNR Rao's statement on inability of these online classes to ignite the mind of the young child, and especially the latest Forbes report, just a day before yesterday, the report was published on the depressing state of the MOOCs. Sir, what is the efficiency of this kind of online system? And
I personally, you see, I think I made my point very clear. And I'm
yes,
very clear on this, that I think it is not a solution. It is the the next best alternate that we have in an environment that we are stuck in.
Yeah,
would
definitely.
I want to do, in a different world, would I want to do this session like this? It is much easier for me, and I think it's much better for everybody to do it in a face-to-face basis. I travel around the country, travel around the world. I don't mind sliding down for a one-day seminar somewhere, and I think that is the most effective way of, a classroom engagement or in office or the social engagement is not just about the delivery. That can be done in any form, which is what MOOCs, recorded modules, whatever all these tools are talking about. what I think what Professor Sena Rao has said, I mean, I'm not trying to get in there. I mean, he is obviously being who he is. I don't want to, but I completely, I don't know about igniting mind, but I can definitely see a lot of us out here, I know there's a lot of us out here are teachers. And one of the things that we enjoy being a teacher is to be able to walk into a class, to see the students' faces, to be able to lecture. Today we are lecturing into a black classroom out here, and I have a TV screen out here where I can see some faces. This is still, people are interested in, but then technically there are things like bandwidth issues and all. People's videos will have to be muted. So I'm just seeing some, random pictures on the screen. What's the big deal? I mean, unless you connect to it, what is this whole? I do not think this can be a supplementary thing. That
Definitely.
do things, but I also, in my opinion, that this is going to land up in the future is a thing that. Well, we'll still do classroom teaching, and I don't think there's ever going to be an alternate to classroom teaching. But because of the efforts that we've put in, we will now say, okay, there are these things that you can read offline, I mean, read outside the class. Please read, please see these videos, please look at it and come, and then we'll have the discussion and we'll continue. But it is not, so it's going to supplement what we will do in class going forward. It is not going to be an alternate, in my opinion, at least not in my lifetime. I expect it to be an alternate to my classroom teaching. And if that happens, I think I'll have to seriously rethink being in this position.
I definitely agree with you. I completely agree with you. Definitely, it cannot be the alternative. If it is only
in the environment we are doing it, it's like if I hold a gun to your head, you will do lots of things. But the question is, at some point, if you drop the gun, you will not. So that's what I want to say. This.
Unless and until we see the faces of the students, we can't ignite ourselves. We can't ignite ourselves.
Absolutely.
We can't fill the class. We need to fill the class.
Absolutely.
Thank you, sir. Thank you again. Thank you.
Due to shortage of time, we are unable to for answering all the questions patiently. I'm sure participants has gained a lot from your answering the question. Without further delay, I would like to call upon Professor Bias Banerjee to give the formal vote of thanks and close the session. Over to you, Professor Bias Banerjee.
I, Bias Banerjee, the faculty of the Heritage College, consider it to be the great privilege to propose a vote of thanks to the dignitaries present here. On the behalf of the Heritage College, I would like to thank our today's speaker, Dr. Shankarshan Basu, for inspiring us with his enlightening and motivational speech. I am confident enough that all of you present here has a lot to take away from the knowledge he shared. The webinar could never been successful without the continuous support of our CEO, Mr. Pradeep Kumar Agarwal, and our respected principal, sir, Dr. Pushpita Ranjan Bhattacharya. Thank you, sir, for your continuous encouragement and support. We are also fortunate enough to get technical guidance and support from our moderator, Mr. Debashish Kormakar, Mrs. Suhashini Chaudhary, and our joint registrar, Dr. Kavita Shastri. A special thanks to our head of the Department of the Commerce, Professor Amitava Ghosh. Thank you, sir, for your motivation and continuous support. Next, I would like to thank today's MC, Professor Namrata Roy, to give a gracious start to the program. I extend my thanks to all the faculties and the support staff for their enormous cooperation in organizing the event. Lastly, I would like to thank all the participants present here to make it a successful event. Now, I would request everyone to fill up the feedback form provided in the chat box. Your certificates will be mailed to the mail ID that you provide in the feedback form. Certificates will be sent as soon as it gets ready. After filling up the form, feedback form, you are requested to log out from the session. Today's session ends up here. Thank you.